So with that, thank you all for joining us. Today, what we'll be covering is just a brief on US equity investing. So I'm Suruchi Jain. I'm Managing Director and Founder of Opportune Wealth Advisors, and we've just begun advising on US portfolios as well. I've been personally investing in the US portfolio since 2015. Not a very big amount, but yeah, we've been tracking it, and we have a few companies as well that we track in the US on a quarterly basis. Then what we're doing is we're covering the basics of US equity investing. Like I mentioned, I've been personally investing since 2015. So hopefully everyone finds this interesting. So, before I come to why us, I wanted to just set the tone for today's presentation. What we'll be covering is why you should be investing in the US equity markets, how to go about investing, where to be investing, and other things that you should be, keeping in mind. With that, just a brief promotion, self-promotion, basically why us? Mainly due to my background and experience. So I was staying and studying in the US for 2 years. Alongside, I was working at Hyde Park Angels, doing a lot of venture capital investing. So sort of seen the startup world, the technology world at the startup level, and have a fair idea of how to go about valuing small companies in India or globally as well. So some of our investors are here, and they would know we have a couple of small caps and mid caps in our portfolio as well. So that kind of comes from my venture capital experience. Post being at University of Chicago, I joined Morningstar. So there as well, I was part of a team of 100 equity analysts spread across the globe. So got to see a lot of different economies, industries across geographies, and so kept the link to the US markets going. So I think I have a fair idea of where the value is in stocks of different sectors. And to that extent, hope that you find this presentation useful. Request everyone to please mute themselves. So with that, let me launch into why you should be investing in US equities. Essentially, if I were just to summarize it in 3 points, it would be the opportunity to invest. It's an opportunity to invest in the world's biggest companies. It is the world's biggest economy, right? And some of the largest companies, Pepsi, Coca-Cola, they're all listed in the US. They aren't listed here in India. Yes, some of the subsidiaries are, say, of Unilever or other companies, but if you actually want a stake in the parent company, then you would want to, invest in the US markets. Second, I would say it's a defense against depreciating rupee in a globalized world. All of us want to take those foreign holidays. We want to send our kids abroad to study. So having some amount of US dollar exposure in the long run, with the rupee continuing to depreciate, year on year, just makes sense if you would like to diversify your portfolio. Third is, of course, diversification. So we will show you with our charts how there's a low correlation on a day-to-day basis between the Indian equities and the US equities. So looking into each of these, some of the global leaders of the world, be it Apple, McDonald's, Coca-Cola, Nike, they're all listed in the US. And the reason is that US equity contributes 53% to the global market capitalization. It is the largest economy of the world. And so you can see, just glancing at the names, these are all names we know really well, but we're not able to buy stock, shareholding in these companies, just being Indian investors. If we look at the dollar hedge, right, versus the rupee has depreciated consistently. So if you just compare the US dollar versus INR dollar, INR return of the Nasdaq 100, it'll make it very obvious to you that the INR converted returns, right? So someone who's a resident Indian and investing abroad, it just makes so much more sense because the difference in returns, you can see the difference in returns per year. It's mostly positive. So if you invest in US dollars and would like to convert it to INR in the future, you know, you're basically gaining just because of that depreciating rupee. So to that extent, we're saying, why don't you hedge your Indian portfolio? Diversification, you know, like I mentioned in the first slide, it's essentially the Nasdaq 100 and Nifty 50. Although, yeah, there are times when they move in tandem, but very often the returns and the way the markets move are quite different from how the Indian markets move. So here the blue line is the Nasdaq 100 or the N100, and the Nifty 50 is, you know, the yellow line. So you can see it doesn't always move in sync. And in fact, they have a very low correlation coefficient of just 24%. Only 24% of the times do they move in the same direction if you see over the last 15 years. With that, let me move into how to invest in US equities. So I'll be covering essentially these are the different options that you can, but I'll also be covering what are the different platforms one can use. And just a quick disclaimer here, they're not all, everything's not exhaustive. There are new avenues for investing in this market coming up almost every day. So, you know, what I'm covering here today is just what is available as of today and what we thought was worth, you know, discussing and presenting. It doesn't necessarily cover everything. So yeah, if you look at essentially, you know, active versus passive, and actually, let me just come back to this. Let me first talk about, you know, how you would go about direct investing, right? So how do you go about investing? So, you know, how you would go about investing, you know, would be through basically a broker, right? And there are a couple of foreign brokers, right, that we find are quite good. Interactive Brokers is one of them. TD Ameritrade is another. Vested is another. And in domestic brokers, we have Motilal, Oswal. They've partnered with Stockal, HDFC Securities, Axis Direct, and you know, ICICI Direct as well. And there are others. Like I mentioned here, others because almost every day there are new ones coming up. There are multiple apps that are coming up, and there are you know, multiple avenues to invest because this is kind of like the hot topic right now. Just to give you an idea of what you might want to look at when you're selecting where you want to invest. I personally have an Interactive Brokers account, but it may or may not work for most of you. And again, a disclaimer, we don't have any tie-ups with any of these people. So this is just for information purpose that we're putting it all here. So essentially what we're doing is just letting you know what are the options. So if we see, you know, Interactive Brokers is a foreign broker. HDFC Global Investing is a local broker. Vested is again a foreign broker. So this is just comparing most of them. HDFC or Motilal Oswal would come in this. And what all features they have is they have some minimum balance requirements, you know, just like some of your current accounts do. They have like a pricing model. Some of them have like a only brokerage model. Some of them have a subscription fees plus brokerage. So it's important that you make that choice well. And then Vested is sort of like a discount broker where, you know, they basically make money for withdrawal and they don't make money on brokerage. So similarly here, HDFC would request everyone to please be on mute. So here, you know, like HDFC Global Investing has subscription fees and brokerage. So of course, this is more of an expensive sort of option. And Interactive Brokers, you know, they have 2-3 options. They require you to have like a, if you have anything less than $1 lakh or $100,000, then they would charge you $10 per month just to maintain that account, right? And you know, otherwise they basically make a very low $0.005 per share, or 1% of order value is what their brokerage cost is if you go over that, you know, $1 lakh. and they have quite liberal withdrawal fees. They don't have like you can do one withdrawal free per month, and then after that they charge you $10 per withdrawal. So you can see like it looks very complicated, but each of them have their own different revenue model. So it's important to understand what your comfort level will be. Towards the end of the presentation, I'll also mention another thing other than fees. What you should also look at is the tax filings and how good their compliance is for each of these brokers, because at the end of the day, when you're filing your taxes, that's what really matters. So with that, let me jump right into how do you go about investing or where to invest, right? So how we divided this up is I've already told you how you go about direct investing. It's basically through these brokers that you would use the direct investing. The indirect is where you would basically do it through your existing demat account, and you would just pick up like a mutual fund or a ETF which is already available to the Indian resident Indians, in their current demat account. So we'll walk you through some of those. But direct is for which you would need to open a fresh broker account with either one of these, US brokers, global brokers, or your Indian demat account, which may have an add-on feature of US investing. So now going to the third topic, which is where to invest. Right? What we've done is we've further broken this down into active investing. What active investing essentially means is where you're actively choosing a stock or a mutual fund to invest in, where someone's actually sitting and like a fund manager, like me, who would help you basically pick up either the correct stocks or the correct mutual funds. And within that, the mutual funds are also selecting where they invest. They're not just investing across the index or something, but they're actually actively taking a role in investing. Passive, the passive options we'll go through in the second part, which is basically either direct ETF or a ETF, which is fund of fund. So when we say passive, you're just putting money in an index or a basket of stocks, which could be as wide as like 500 stocks or 3,000 stocks or 100 stocks. We'll show you all those options as well in the passive section. So moving on to direct investing, right, in individual stocks through an active route. The red blob is what I'm going to cover, individual stocks. So how would you go about individual stocks? So for individual stocks, Opportune Wealth could be your fund manager, and this is how we would go about it. So this is a quick look into how we look at selecting companies, and this is our research methodology, not only in India but also globally. We would share the same methodology. Essentially, what we're looking at is we're looking to pick up select industries. Within that, we're looking at winning companies. We're looking at companies with sound management and fair valuations. So we're not trying to choose a cheap stock or the hottest stock. So to give you an example, like Tesla is not on our list. We don't look at Bitcoin. We don't look at cryptocurrencies. So we're looking at stable returns, good returns. We're looking at wealth creation over the long term. Yes, what we are looking in select industries, let me quickly walk you through. And more of this is there on some of our other videos, which we've put on YouTube, which discuss in detail how we'll do our Indian equity research. But I just wanted to share these two slides because the research methodology across the US market also remains the same. So what we like in certain industries, and the industry becomes very, very important when you're looking to invest. What we don't like is asset heavy industries, high capex or slow growth. So we typically avoid oil and gas, cement, power, automobiles. That's why I said, Tesla or anything in the electric vehicle space is not currently in our portfolio, nor is cryptocurrency. What we do like is asset-light companies, strong cash flows and high growth. So essentially there are financial services, pharmaceuticals, FMCG, technology and IT. With that background, I can just share a few names of the investment list that we have. We do have US stock coverage list, and we do follow the same approach. These are some of the names that we currently have in our portfolio: MasterCard, Amazon, Visa. This is not all. There are other companies as well. It's sort of a concentrated portfolio right now, but we're quite happy with what we've chosen. So moving on to active investing in mutual funds. So what does that look like? So if you are looking at it can be done from India, right, using a fund of funds strategy, and there are a couple of options available. So this you can do through your existing demat accounts. There are a few mutual fund schemes available, right? These are some of them. Again, like I said, there are new mutual funds being launched practically every day. You can see the Nippon US Equity Opportunities Fund is just 400 crores in AUM. And this DSP US Flexible is just 414. That means they're just really newly launched ones, right? Like these are still at least 2015, 2012, right? But there are still new ones in 2019, 20 that are coming up. So essentially what we like is the first two, the ICICI Pru US Blue Chip Equity Fund. So this was actually launched while I was at Morningstar, and the research that goes behind this is the Morningstar research. So they actually use the 100 analysts of Morningstar to fuel their research of the US market, and they invest in about 40 stocks. It's important to note there is an expense ratio, so obviously there are some expenses. It runs just like a mutual fund, right? It's just that it's investing in the US market. And the Nippon also invests in about 25 stocks, right? The ICICI Pru invests in about 40 stocks. And you can see the expense ratio is a little over 1%. And there are these two fund of fund. Essentially, what fund of fund means is that the DSP Flexible Equity Fund, they would invest in another fund, which would be an active manager within the US. So essentially, it's one fund feeding into another fund. That's what the difference is. So even the Franklin feeder fund is the same, where one fund just feeds into another active fund within the US. Just a little bit about this, and again, like we don't have any tie-ups with Nippon or with ICICI as such to kind of distribute these, but we'd be happy to assist you in investing in case you are interested. Yeah, this is essentially just to give you a snapshot of what each fund looks like. So what the Nippon US fund does is it invests in US large caps, right? Like I mentioned, it has about 25 stocks. Expense ratio we mentioned is 1%. Long-term capital gains is considered after 3 years for mutual funds. And in US investing for direct stocks, it's considered as 2 years. So that I think is important to keep in mind. Less than 3 years is considered as short-term capital gains, and it's as per tax slab. This is just an idea. The minimum investment here is 5,000, and one can start an SIP, right, for as low as 5,000, and then subsequent denominations of even 100. There is an exit load of 1%, for redemption within 365 days. We like the US Equity Opportunities Fund because I think, we already mentioned that these are the 4 sectors we like: services, technology, healthcare, and financial services. So if you can see, they are quite heavy on these 4 sectors that we think have long-term potential. So that's the reason that we like this fund. Similarly, ICICI Pru, I mentioned that they were working with Morningstar back in 2012. I'm not sure what the arrangement is right now, but essentially here as well, you can see the minimum investment is 5,000. They're definitely trying to get the US market actively available to retail investors in India, and minimum SIP is 100, and exit load is 1%. Again, here you can see, their allocation is to the segments that we prefer. Technology is 25% of their portfolio, healthcare is 18, services is 17, FMCG is 15. Moving on to the passive options available. Again, first I'll talk about the direct ETFs. So this, if you have a foreign brokerage account, you can actually buy the ETF directly. It'll appear just as a stock holding in your portfolio and in your demat. And the taxation will be similar to stocks, not similar to mutual funds. And if you do the indirect route, then you can actually buy a ETF, fund of funds, with a domestic AMC. That also we'll just show you a couple of popular options. So what exactly is passive investing? Essentially, what you're saying is, just like in India, you invest in the Nifty 50 or the BSE 30. In the US as well, you could basically choose any of these three indices. So one is the Dow Jones, total stock market index. That's what we've called it, but it's basically just called the Dow Jones index. S&P 500 index, Nasdaq 100, right? So what basically is, each of these has a different composition, and I'll just walk you through each of them. And Dow Jones has more than 3,000 companies part of it. S&P has 500 companies, and Nasdaq has 100. So if you essentially see, these are the three indices, and you can see that Nasdaq essentially, has been outperforming, and that's because it is more technology heavy, and that's how over the last, 2-3 years it has been outperforming. The S&P 500, comes to a second, and Dow Jones the third. And essentially, this is where you see the law of averages, right? Like if you try and invest in more and more diversified portfolio, like diversification is good to a certain extent, but if you over diversify, then your returns will actually come down. So you can see that the returns for the total industrial index is 22% versus the returns for the Nasdaq 100 is 35%, because this is probably an over diversified portfolio, which has given us 22% returns, which is also not bad though. Just to walk you through the composition, because that's exactly what we were looking at even on the mutual fund space. The Dow Jones index composition is still 27% technology, right? 17 is financial services, consumers is 14%. What makes it average down, I would say, is basically these other segments, which we don't put money behind. But since it's the total index, it has to have oil and gas, utilities, basic materials, and telecom as part of its composition. The S&P 500, again, you can see technology is 27%, because a lot of the US companies are tech focused. Healthcare comes second, consumer discretionary is 13%. So over here also you can see there is still some energy, materials, utilities, and real estate, which again averages it down. Whereas in the Nasdaq, this is the benefit. Essentially, you're not diversifying away your profits. Technology accounts for 57% of the index. Consumer is 22%. Utilities is just 1%, and telecom is 1%. Basic materials, oil and gas, financial services are completely missing from the Nasdaq 100. So, essentially, we prefer the Nasdaq 100 as, just our suggestion. So coming to, the ETF fund of funds options, through the domestic AMCs, these are the ones that are available to you as a domestic investor who's looking to get US exposure. There are very few passive funds available currently, but new ones are being launched practically every day, like I mentioned. You can see that these are the ones that we have, and of these 4 that are listed, we've chosen the 2 longest running ones. The Motilal Oswal Nasdaq 100 ETF is essentially a ETF which invests directly in the Nasdaq 100, and that's been around since 2011. Whereas the Motilal Oswal Nasdaq 100 is a fund of fund. That means it invests in a fund which invests in the ETF. So you can see the expense ratio is higher, and it's also a more recently running one since 2018. If you see the bottom 2, the Motilal Oswal 500 index fund, that was only launched in 2020, and the Kotak one was launched literally like this year. So definitely, I think if we were to do this a year down the road, we'd see a lot more names here. for sure, because this is a place where people are, investing time and effort to launch these. Just taking a quick look at the Motilal Oswal Nasdaq 100 ETF, while the underlying Nasdaq 100 ETF is the same, like we just want to explain to you the differences. Essentially, that one is a fund of fund and one is the buying the ETF directly. So the only difference, like I mentioned here, is the expense ratio. And of course, I think on the exchange rate as well, there's probably some differential which is not evident here. But if you were to invest in both of them on the same day and then redeem on the same day, you'll probably be better off going with the Nasdaq 100 ETF versus the fund of fund. I have personally invested in the fund of fund, and I think that's just because before I recommend anything to my clients, I always make myself the guinea pig and try it on myself. So I've just recently done this. So what exactly is an exchange traded fund? What it's doing is basically it trades on the NSE, BSE, right? And so that's why it's available to investors. But the underlying is the Nasdaq 100. Again, here the minimum investment is 500, and additional investment is also 500. So they've kept a really low bar. In fact, the first time investment I think is 1,000 rupees. This is taken from their deck, so but I think the minimum is 1,000. Then this is the fund of fund. You can see that it's quite similar. There are no lock-in periods and exit loads, so I think they're just trying to get as many people to invest here as possible. Nothing wrong with that. And you can see that the scheme is still growing. It's AUM, but 2,500 crores is also quite a significant start. And you can see that they have the mutual funds have a 3-year LTCG, right? These are basically the investing rules that have been set for these mutual funds and fund of funds. So just a quick look at point number 4 on my agenda, which was what are the other things you need to keep in mind. Essentially, what we need to keep in mind is that there are certain restrictions and taxations one needs to keep in mind. So as an Indian resident, you can actually invest up to $250,000, so around 2 crore per year, without any special permissions from the RBI. One should note, though, that all remittances, one-time remittances over 7 lakh will be charged a TCS, which is a tax collected at source, of 5%. And this can be availed as a tax credit in your income tax filings. So it's just a way for the RBI and the government to keep track of, how much money you're sending abroad. Thankfully, there are no such restrictions if you wish to repatriate the funds back to India at any point in time. But yeah, the limitation set here is essentially to manage the current account deficit. Taxation, I've kind of just put this table here, and I'll be covering it in the next slide as well. What taxation rules are there is essentially there's a double taxation avoidance treaty that both US and India have signed, which allows taxpayers to offset income tax already paid in the US with what they pay here. So for example, the dividend tax. So all dividends received on in the US are 25% is tax deducted at source. And since in India you will be basically paying applicable income tax here, you have a set off. So if your income slab is at a below 25% tax payable, then you'd get that tax credit back. And if it's more, then you would just be paying the balance tax as required by the Indian government. One should note the capital gains tax as well. The short-term capital and the long-term capital gains is under and over 24 months versus 12 months, which is what it is for Indian tax laws. For US, it is 24 months is considered the short-term capital gains, and long-term is considered over 24 months. And long-term capital gains is taxed in India at 20%, and short term is taxed as per income tax slab rate. So the tax rules are also, you know, favorable to people holding for the longer term. I think why we mentioned the taxation bit is because you know, while it's all very exciting to invest in the US market, one has to be aware that it comes at the cost of compliance, right? You are investing in a foreign country, in a different denomination, and you need to be aware that there will be additional paperwork. So it's important to choose the right broker as a result, because for your income tax filings, those will be very helpful. What I have found in my experience with interactive brokers, while they are onboarding you, you know, they make you sign a ton of paperwork, and then every year they make you sign a form which says that you're not a foreign taxpayer and that you qualify, you know, as an Indian resident taxpayer, and then they basically do all the back end paperwork for you. Also here you have to have a good you know, CA who would be able to take care of your foreign holdings and your you know, foreign tax liability, because the last thing you want is further scrutiny because you decided to invest abroad. And so, you know, while it's, like I mentioned, all very exciting, you should definitely make sure that the appropriate information is shared with your CA and you sign up with a good broker. Just a couple of disclaimers. You know, like I mentioned, I have investments in the stocks, the few stocks that we mentioned for direct investing, and also in the Motilal Oswal fund of fund. We also have a tie-up with Motilal Oswal. So since we have both the ARN and the advisory license with us, so, you know, with that disclaimer, I'll bring this to a close. Thank you so much. I'm available at suruchi@opportunewealth.com, and my team's available at clientrelations@opportunewealth.com. If you have any questions, I'd be happy to take them now. Any questions?
So what's your recommendation between stocks and I mean, my sense is, you know, given the fact that there has been a bias towards active involvement and not passive, would you recommend an active sets distributed between stocks and the mutual funds?
Yeah, I would say so, because you know, that's what we are doing with some of our clients, you know, do like a split.
Understood.
And see
Understood.
over the next year or two, you know, how we perform versus. That's
Sure.
always been our strategy, to always you know, benchmark and then take it forward.
Understood. Understood. And in these three stocks, you continue to see a future ahead? I mean, the stocks that you had recommended, or you would keep recommending more?
So I think, you know, we definitely see a future in the stocks. I haven't looked at the price lately. I don't track price every single day. But you know, definitely we definitely see you know, a future. At the current price, I'll have to see what the price is right now and see what we would allocate to different you know, stocks.
Sure. You would have a recommendation which is different as of this point in time for a portfolio of stocks?
Different from?
Different from the three that you had mentioned in one of the slides?
Yeah, we have more stocks. We have all of them here.
Understood. 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 Super. Thank you.
Thank you. Okay, I can see a few questions here. Any global fund recommendations where US is one market and not the only market? Yeah, I mean, it's an ocean out there, you know, Rajat. So we consciously didn't cover the global investing part because there are many options there. And I'll be honest and say that we haven't fully researched it. We know that US investing is a good, avenue. And so we wanted to focus our, efforts there.
Got it. Thank you.
And I think there's one more question. Can you talk us through a little more on your stock advisory platform for US and ballpark fee brokerage? Okay. So our fee structure is pretty standard. We charge a 2.5% per annum fee on the assets under management. Of late, we have started taking a haircut to that. If you go over like a 50 lakh portfolio, we reduce it to 2.3%. If you go over 1 crore, we take it down to 2%. So those are the slabs that we have. So our fee structure will remain the same, whether it's US stocks or Indian stocks. And with the US stocks, obviously, you'd have to share the information. We wouldn't be able to kind of manage it for you. We anyway wouldn't manage it for you, even in the Indian stocks. We essentially have the partnership with Motilal Oswal, so they share your information with us, but you still have to, it's all non-discretionary.
But
So,
is transaction cost a big part of what you spend if you invest in US directly, as in currency loss every time you convert currency, brokerage loss?
no, so actually the options that we've suggested, brokerage is really minimal. If you go through one of those foreign brokers, something like Interactive Brokers. And I think if you're investing like a significant chunk, obviously, if you're investing a very small amount, then, we may not even charge you fees on that until you kind of get your feet wet and, begin investing a lot more. But the idea is to basically add it to your portfolio as an overall diversified, portfolio for a long term, say retirement planning, or, whether you're looking to fund the education of a young one in the future. But we do have other fee models as well that we'd be happy to discuss, offline. I hope that answers your question, Rajat.
Yeah, I was more concerned about the currency and brokerage thing. Got your answer. Yeah, all about ticket size.
Yes, and that's honestly a new approach. Earlier, we used to have, one size fits all. Great. If there are no further questions, I'll bring this session to a close. Thank you so much for joining us. And, we look forward to having you at our other webinars. We'll also be sharing a recording link of this session. So please do share it with your friends. Thank you.